It does take us to our talk of the tape today. This market's unique ability to brush off almost anything thrown its way, and how long that can really last. Let's ask Gabriela Santos, JPMorgan Asset Management's global market strategist, and CNBC contributor Joe Terranova of Virtus Investment Partners, both, as you can see, with me here at Post 9. Good to see all of you. It is a resilient market, is it not, Gabriela?
It is quite resilient. I mean, we know through the end of May, it really was about the AI turbocharge of a handful of companies. Since May, we've had more participation from cyclicals as the data has shifted the narrative much more towards a soft landing. It has been surprising that even though we've seen a backup in real rates, close to 200 basis points, we haven't seen a bigger correction in long duration stocks. We've seen some, but we haven't seen as big of a correction as we would have expected, given naturally would lead to more of a focus on valuations. And we know the largest of those stocks are quite extended when it comes to valuations.
Yeah, I mean, it's been a surprise to many, not least of which Ken Griffin of Citadel, of course, who was on the network earlier today. Here's Ken on this resiliency we've seen in the market.
It's been a really good year for the market, particularly with the backdrop of higher real interest rates. So if you look at both the yield on the 10-year bond and, more importantly, the real yield, for example, in the 5-year TIPS bonds, we've seen, again, an increase in real rates and nominal rates, and yet the stock market's been resilient. So that's a really interesting year to see the resiliency of our stock market against this backdrop that would usually be very challenging for equities.
All right, so that's Ken Griffin. So, Joe, why hasn't it been more challenging?
So you always want to put a bull market in context and understand the fundamental catalyst behind it. I want to go back to August 18th. The S&P was 43.35. We're up 4% since then. Let's remind ourselves what this bull market has had to overcome since August 18th. We heard about at the end of August that NVIDIA and the price action that day was indicative of an inflection point for the market. The price of oil on August 24th was $77.50. It's above $90 today. We got through unemployment. We got through CPI. We got through retail sales. And we are coming up towards the end of the quarter ahead of an earnings reporting season. Normally, what happens? We see earnings estimates lowered towards the end of the quarter ahead of the earnings. In fact, what's happened? Earnings estimates for technology has moved higher by 7%. The revisions are actually positive. So you tell me, if you are bearish and you are of the belief that this market is going to roll over significantly, it's going to give in to the overwhelming force from Treasury yields, what in fact is going to be the catalyst? Because we've overcome all the catalysts that were supposed to in a seasonally weak period defeat that bull trend.
I think that's why Ken Griffin, among others, are somewhat surprised, Gabriela, as to why we've been able to overcome all of that. The question I asked Joe, I'll ask you, is why? Why has this market been able to look past, most of what's come its way, and that's why we sit here, north of 4,500 on the S&P 500.
I do think this earnings piece is so key because we talked about for the first 6 months of the year how it was all about multiple expansion. What's happened since the end of May is not just that the macro data has been better than expected, but also earnings have been better than expected. And so since then, we've had an upward revision in next 12-month earnings of 4 percentage points. So it's more about favorable fundamentals rather than just pure valuations alone. With that said, we do think it is surprising that valuations, quality, dividends, your traditional factors that would do well when you have these positive high real rates haven't been doing as well, and that's something we think will change. So we're bullish on the market. It's just how you actually invest based on a more positive macro and earnings view that we think is more nuanced.